Alright, so let's move on to the short setup entry rules. When do we go short for the EMA bound setup? So obviously we go short when we see a clear downtrend on the FX pair. So a clear downtrend is signaled by the price below the 18 EMA, 18 below the 50 EMA, and the 50 below the 200 simple moving average. So clear downtrend. Next, we want to see that the 50 EMA has been tested at least once recently to be a strong resistance level. So for example, you can see that this is a clear downtrend. And again, we can see the 50 moving average being tested. This blue line is the 50 EMA. Again, we're going to see it being tested as a strong resistance, coming down. It could be tested here again, coming down. And finally, when it goes up, we want to sell right at the 50 moving average to catch the next wave down. All right. So the next thing is to look at the higher time frame once again. Once you look at 50-minute candles, go to the hourly candles. Hourly candles must also show a downtrend. Again, price below 18, 18 below 50, 50 below 200 moving average. And as per the long setup, for the short setup, we also want to see a wave pattern. This time, we want to see a downtrend wave pattern. So again, how do you define a downtrend wave pattern? Lower highs and lower lows. So ensure that the recent swing low is lower than the previous swing low. So again, what does this mean? So its price is going up and we're looking to sell over there. All right, so this is known as the recent swing high, and that's the previous swing high. This is the recent swing low, and that is the previous swing low. So the first thing is to ensure that the recent swing low is lower than the previous swing low. So it's making lower lows, very important. So for example, if this is A, point A, and this point B, point A has to be lower than point B for this to be a valid downtrend wave pattern. Next, the recent swing high, which is here, which is our intended entry price. It's a recent swing high that we are going to anticipate is going to come down, right? So the recent swing high must be lower than the previous swing high, so lower highs. So again, if you call this if you call this C, and you call this D, for example, D has to be lower than C or equal to C, right? But D cannot be higher than C, very important, okay? So the swing high is lower or equal to the previous swing high. All right. Next, ideally, we also want to ensure that the 50 moving average resistance here coincides with a horizontal support or resistance level, okay, and or a Fibonacci level of 50% or 61.8%. Okay, so this should be resistance level. All right, so again, what do I mean? Let me illustrate with a drawing. So we see it on a downtrend like so. Okay, and so remember that on a downtrend, the impulse wave is going down, A to B, right? And then it goes to C. So C is our top of the retracement, right? So imagine this is the 50 moving average here. That's the 50. So if we retrace A, B, C, if C is at the 50% or the 61.8% Fibonacci level, and that coincides with the 50 moving average, that is additional confluence. So that tells us it's a very strong resistance, likely is going to find resistance and continue the next impulse wave down. So that gives us more confidence to sell short at that 50 moving average because it is confluence with a Fibonacci level, right? Or we see this pattern. All right, so we see this pattern like that. Let me draw that again. Okay. Like so. Okay. So again, this is the 50 moving average. Say this is a 50 moving average like that. Okay, there's a 50 moving average. So in this case, you can see that this is the recent swing low, and that's the previous swing low, right? So recent swing low is lower than previous swing low, lower low, right? That is one of the criteria. And the recent swing high, which is our intended entry price, where we're going to sell short, right? Finding resistance at the 50 moving average. Now, if this happens to coincide with a horizontal resistance level, for example, there's a resistance here, again, it gives us more confidence, because not only is it hitting a 50 moving average, it's also hitting a resistance level. And if we sell short there, it's going to be more powerful, right? So again, it is not a must-have, but it's a good to have. All right, so once we have validated the pattern, again, we ensure that the 50 EMA has been tested before to be strong over there. Could have been tested here as well. And now it is bouncing off the 50 moving average. We are looking to take a short position, to sell short, to enter short. And again, we have to ensure that the recent swing low is lower than the previous swing low, right? So makes lower lows, and the recent swing high, right? Recent swing high, which is basically where we are looking to enter, is lower or at the same level as the previous swing high, but not higher than the previous swing high. All right. So once we see that pattern, we're going to enter the trade. So for the entry, similarly, we place a sell limit order right at the 50 EMA resistance. So again, as we are placing the order, the price is going up, going up, going up. And we are going to assume it's going to hit the 50, trigger the order, and go all the way down, right? So right now, as the price is going up here, and we see that it's going to hit the moving average, we place our entry price there. So again, it is a sell limit order, which means it will sell at that price or higher, okay? So for example, the entry could be at 1.2850, for example, okay? So again, only if the price rises to 2850 or higher will my order be triggered and filled, and hopefully bounce back down again. So once I've got my entry order, I place my stop loss concurrently. So my stop loss is a buy stop order at least 8 pips above the entry price. So between 8 to 12 pips at least. For pound pairs, use at least 12 pips. So again, if I put my stop loss 8 pips above my entry price, it will be 2850 plus 8. So my stop loss would be at 1.2858, for example. All right, so that's my 1 hour distance. Again, my stop loss distance from the entry price to the stop loss price is the 1 hour distance. This again should be at least 8 to 12 pips, as mentioned previously. Again, it could be more than 12 pips, it could be 15, 20, 30 pips, but at least 8 to 12 pips, all right? And next, my target price would be placed 2 hour below the entry price. So if 1 hour is 8 pips, 2 hour is 16 pips, that's right, okay? So my target price would be 16 pips below the entry price. So 2850 minus 16 would be 1.2844, for example, right? There we go. And again, ideally, if my stop loss is above the previous swing high, that is an ideal case scenario. So sometimes I may want to move my stop loss slightly up to make sure it is above the previous swing high. Again, it is not a must, it is good to have. right? But always ensure that you have to be able to reach 2R. Your target price must be reached before hitting the recent swing low. In other words, the target price must be above the recent swing low over here. Yeah. And again, as usual, before setting the trade, always look at Forex Factory, look at the upcoming news for the day. Is there any red news for this currency pair? If it is, avoid taking the trade 10 candles before the news is released, or about 150 minutes, or 2.5 hours. So let's take a look at a few examples and see, would you take this trade? So for this first example, it's the New Zealand dollar. It's on M15 candles, and you can see it's a clear downtrend, right guys? So the 18 EMA is below the 50 EMA, below the 200 moving average. So it's a clear downtrend, and you can see that the 50 moving average has been tested to be strong recently, right? So there's a strong test of the 50, and right now the price is going up, going up, going up, and it is hitting the 50 moving average. Okay, so question, would you take this trade? Would you put a sell order right there at the 50 moving average? Would you anticipate that it's going to come down? Okay, would you put a sell order here, sell limit order? So again, take a minute and think about it. Does it fulfill the criteria we have talked about just now? Okay, give yourself a minute and think, would you take this trade? All right, have you made a decision? Okay, so let's see. Would you take this trade? The answer is you should take the trade because it meets the criteria. Does it have a clear downtrend wave pattern? Well, let's check. Where is the recent swing low? The answer is there. That's a recent swing low, right? Where's the previous swing low? Well, that's the previous swing low. Okay, so the recent swing low is lower than the previous swing low. So in other words, it makes lower lows, one of the entry criteria. Next, where is the recent swing high? This is the recent swing high, or where we intend to sell. And is the recent swing high lower or equal to the previous swing high? Where's the previous swing high? There we are, there's the previous swing high, right? So it goes like that, like that, like that, like that, like that, okay? So you can see it makes lower highs and lower lows. We want to see that downtrend wave pattern, right? So it fulfills all the criteria. So it is a valid trade. And again, it so happens that this recent high where we're going to sell also coincides with a Fibonacci level, right? So again, when you're drawing Fibonacci, you must always identify A, B, and C. So on a downtrend, it's always what? A to B, which is the impulse wave in the direction of the trend, to C, which is the retracement. So impulse going down, retracement going up, and continuation of the trend. So in this case, where's the A? Well, the A is over here. That's the A, right? A is the start of the impulse wave down. Where's B? Is B, right? So A to B to C. There we go. A, B, C, right? So if you use the Fibonacci retracement tool, you click A, right, and you drag to B, you notice that C is exactly on the 61.8% retracement level. So that tells you that, hey, that's a really strong level. It's hitting the 50 EMA and hitting the 61.8% level. So very high chance it's going to go down. I will sell short over that. Okay, so this is a valid trade. Got it? All right, on to the next example. Next example is franc yen. Again, look at the 50-minute candles. Are we on a clear downtrend? Yes, right? Over here, 18 below 50, 50 below 200. Clear downtrend. Was the 50 tested to be strong? Not really, right? Yeah. Can you see that the 50 moving average, which is here, it did not act as a strong resistance. In fact, the price blasted right through the 50. So that was not a strong resistance. So that really fails one of the first criteria, which is the 50 EMA must be tested to be strong. So that's not strong. Okay, what else? where is the recent swing low? This one, there's a recent swing low, right? Over here. Recent swing low. Where's the previous swing low? Here. That's the previous swing low. So remember, on a downtrend, the recent swing low must be lower than the previous swing low, must make lower lows. But in this case, it is not making lower lows, it is making higher lows. This recent swing low is higher than the previous swing low, so that is not valid. Not valid, right? But the recent swing high is lower than the previous swing high. So this is valid, but that's not valid, right? So this is not a valid short trade because of all those factors. Now let's take a look at specific trade examples. So for the first example, let's take a look at New Zealand yen on the 16th of November. And again, these are the 15-minute candles. So first of all, we see a very clear downtrend with the 18 EMA, this blue line over here below the 50 EMA and below the 200 simple moving average. So clear downtrend. Next, we see the price finding resistance at the 50 EMA. So it has been recently tested to be strong, hits the 50, comes down. Right now it's going up and it's going to hit the 50 again. So at that point of time, we're getting ready to place our sell order right at that 50 moving average, and we are hoping it's going to hit that price and we get filled at that price, and then it will go down as we anticipate. So first of all, is this a valid trade? Yes, because we have a downward wave pattern. Where is the recent swing low? This is the one, right? Our recent swing low. And our previous swing low is here. That's the previous swing low. As you can see, it's like that, up, like that, up, right? So swing low, swing low. So the recent swing low is lower than the previous swing low. So it is a valid setup. Next, where is the recent swing high? It is here, right at the 50 moving average, where we intend to enter our order. So there's a recent swing high. Where's the previous swing high? Here, right? So if you take a look, goes down, swing high up, comes down, swing high up, and anticipate it's gonna come down, right? See the wave pattern, right? So the recent swing high is lower than the previous swing high. The recent swing low is lower than the previous swing low. So downtrend wave pattern is all valid, right? So because of that, we are placing our sell order right at the 50 moving average. So it's a sell limit order of 77.57. So again, as we're placing the sell order, the price is still going up. All right, and we want it to hit 77.57 and fill the order and go back down again. All right, so again, once we place the order, the price doesn't always reach our intended entry price. In fact, if it doesn't reach and it goes down without reaching, we cancel the order. It's not a valid trade. Okay, so in this case, you can see that it did go up to hit our sell order before continuing the downtrend as we anticipate. So our sell order at 77.57, where's our stop loss? Again, stop loss should be at least 8 pips above the entry price. So 77.57 plus 8, we get 77.65. So 8 pips. And again, it so happens our stop loss is above the previous swing high. Just above the previous swing high, which makes it ideal. Just nice, okay? So 1R is 8 pips. What is 2R? Times 2, 16 pips. So our target price would be 16 pips below the entry price. So be 77.57 minus 16 is 77.41, which is right there. All right? Next, we check on the hourly candles. So click on H1. And on the hourly candles, you also want to ensure a downtrend. H1 must be aligned to M15. So on the H1 candles, The 18 EMA, which is the blue line, is below the 50, and the 50 below the 200. Now you can't see the 200 is somewhere up there, but they're all in a very clear downtrend sequence, okay? And again, on the H1, you can see that this 18 EMA has acted as a resistance before. And the good news is our stop loss, 77.65, is above that moving average resistance. So again, it gives me more confidence that my stop loss will not be hit very easily because I've got a moving average protecting my stop loss over there. Okay, so I'm looking to sell over there, stop loss over there, profit target over there. And again, my profit target is above the recent swing low. Okay, so let's see how this trade played out. Okay, so you can see it played out pretty well. The price went up here, and you can see that it triggered 77.57. So I was in the trade, and you can see it went sideways, right? In fact, it almost hit the stop loss here. You can see it almost hit, missed by about 2 pips, all right? Went sideways, and eventually, boom, it hit the target price. So again, this turned out to be a winning trade. Yeah. So again, you don't always get winning trades. You can follow the setup precisely, follow all the rules, and you could have hit the stop loss just as easily. So remember, on a trade-by-trade basis, again, the outcome is random. You never know when you get a win. You never know when you're going to get a loss. But do this again and again, repeat the process, and you know that you have more wins than losses over a large sample of trades because we are trading with the trend and probability is in our favor. So that is the New Zealand yen trade that I've just shown you. So on to the next trade. This is New Zealand USD, 15th of November. Again, a valid bound short setup. So let's take a look at the rules. So first thing is we see a clear downtrend with the moving averages in sequence. Again, the 18 EMA, blue line below the 50 EMA, and that is below the 200 simple moving average. So clear downtrend. And you can see the pattern over there, goes down, goes up, goes down, goes up, down, and up. There we go. All right. So first, do we have a clear test of the 50 moving average? Yes, we do. So you can see here, the 50 moving average was recently tested to be strong. Okay, and the price goes down, goes up, and again over here we are looking to sell as it hits the 50 moving average, anticipating that it will continue the downtrend. So again, are we confident that it will be a strong resistance? Again, let's look at the wave pattern. So where is the recent swing low? This one, that's a recent swing low. Where's the previous swing low? It will be over here. That's the previous swing low. Right? So it goes down, swings up, goes down, swings up, right? So again, recent swing low below previous swing low, making lower low. That is a valid downtrend wave, okay? Recent swing high would be here, where we intend to enter our trade at the 50 EMA. So that's a recent swing high, okay? So recent swing high, and the previous swing high is here, right? That's the previous swing high. So previous swing high, recent swing high. Recent swing high below previous swing high. Recent swing low below previous swing low. So lower highs, lower lows. Clear downtrend wave pattern. We are confident that it will go down. Okay. Now, in addition, like I said, if our 50 moving average coincides with a Fibonacci resistance level, that gives us more confidence. So again, if you take this as the start of the downtrend wave, A to B, right? A to B to C, right? So use your Fibonacci tool, click A, drag to B, and you can see that it retraces to 61.8, which is exactly at the Fibonacci level. So that gives us even more confidence that this will be a resistance. So once we are confident of that, we place our sell limit order at 6866, ready to be triggered. So as the price is going up, we place our sell limit order over there. We place our stop loss 8 pips, at least 8 pips above the entry price. In this case, it'll be 6874. Okay. Again, ideally, you want the stop loss to be above the previous swing high. It is not. It is below, but it is still valid now. So question would be, why don't I raise the stop loss higher to be above the previous swing high? Now, I'd like to do that, but the trouble is, if I do that, what will happen? That's right, my 1R would be bigger. And I'll not be able to reach my 2R profit target easily. In fact, the 2R profit target will be below the recent swing low, which is invalid. Remember that my profit target must be above the recent swing low, because the recent swing low could act as a resistance, as a support. So I have to be able to take profit before the support is reached. And that's why I can't afford to raise my stop loss much higher. I have to keep it at 8 pips for the purpose of maintaining my 1:2 risk to return ratio and profiting before the recent swing low is hit. That's the reason why. Okay, so my profit target is placed 2R below the entry price. So 2 times 8 is 16 pips. So 6866 minus 16 is 6850. So my profit target is right at the recent swing low, right there. I can't afford to go lower. I can't. All right, too dangerous. So again, I click on H1 hourly candles to check that H1 is aligned as well. So on the hourly candles, you can see H1 is here. We see the clear downtrend pattern again. 18 EMA below the 50, 50 below the 200. Clear downtrend pattern. Okay. Our profit, our entry price is here. Stop loss is over here, and profit target is over here. Okay. And again, you can see on the hourly candles, this blue line, 18 moving average, is a resistance. Can you see? Resistance. And again, our stop loss is above that resistance level. So again, that gives me confidence that my stop loss will not be hit easily because it is protected by this 50 EMA, or rather this 18 EMA resistance level. All right. So once I place the order, over there, you can see it got triggered. The price went up, triggered the order, and let's see what happened after that. There we go, right? So it triggered the order, sold there, boom, came down, went up, went down, hit my profit target, and again, this was a winning trade of 2R. Yeah. So again, to address that question that some people ask, why would you put your sell order right at the 50 moving average, right? Wouldn't it be better to wait for the price to reverse and you get a confirmation candle red before entering the trade? And again, I do that for stock trading. I don't do that for forex trading, because for forex trading, it is so volatile that I have to get in right at the 50 moving average resistance. By the time I wait for the confirmation candle on the that appears here, this bearish candle, and if I enter there, I would have already missed out a lot of profits, and I will not have a good risk to return ratio. So that's the reason why I must enter right at the 50 EMA resistance for forex 50-minute candles. Okay, so I do hope you understand the concept of the setup. If you've got questions, please send me an email so I can clarify your doubts and questions. At the same time, let's take a look at some live trades I've done on the short bounce setup. So before we take a look at some of these live trades, let me show you some charts and you tell me if these are valid short bounce setups based on the wave patterns. So again, this is on dollar Canadian, and you can see that the price went up, tested the 50 moving average, came down, went up, came down, and now it is hitting the 50 moving average. So again, would you sell there? Is this a valid trade where you're going to place your sell limit order there? Take a minute and think about it and let me know your thoughts. Okay, have you got your opinion? Do you think it's a valid trade? Would you take this trade? Well, the answer is no, you shouldn't take this trade. It is not a valid trade. Why? Again, although you see a clear downtrend with the 18, 50, and 200, you see the 50 EMA being tested, but it is not a clear downtrend wave pattern. Why? First, where is the recent swing low? The recent swing low is here. Okay, where's the previous swing low? Here. Right, as you can see, it goes down like that. Can you see? So this is a swing low, and you can see that this recent swing low is higher than the previous swing low. So that is not valid. Remember that the recent swing low must be lower than the previous swing low. It must make lower lows. But in this case, it is making higher lows. So that is not a highly probable downtrend setup. Okay? Next, where's the recent swing high? Over here, right? That's a recent swing high. And the recent swing high, where's the previous swing high? Well, over here, that's the previous swing high. Okay? So you can see that the recent swing high is higher than the previous swing high. So again, that is not a very good setup, right? Again, it should make lower highs and lower lows. In this case, this high is higher than this high. This low is higher than this low. So it tells you that this downtrend wave could in fact be going higher, right? So it is not a clear downtrend, it is an invalid trade. You have to ensure you understand this concept. It's really important. Okay, next example, Euro USD. Once again, downtrend pattern based on moving averages, 18 below 50, 50 below 200. 50 tested to be strong, Again, the price is going up here. Would you place a sell order right there to catch the trade and attempt, or rather anticipate it's going to go down? Yes or no? Take a minute, think about it, let me know. Great. So what do you think? Is it a valid trade? If you said yes, you are absolutely right. It is a valid trade. Why? Because, okay, again, where's the recent swing low? There you go. Where's the previous swing low? There, right? So swing low, swing low. Okay, so this swing low, recent swing low, is lower than the previous swing low. Good, lower lows, right? The recent swing high, which is our intended entry price, right at the 50 moving average, is lower than the previous swing high. Okay, so lower highs, lower lows, confident downtrend wave pattern is going down, baby. So we dare to put a sell order there. All right, great. So now let's take a look at those live trades so you understand how I manage the trades in real time. This concludes lesson 2, the moving average bounce strategy. Hope you enjoyed this strategy. If you've got questions, again, send me an email. I'll be happy to clarify your doubts and your questions. And with that, may the markets be with you. Happy trading, and I'll see you in the next lesson.